Hello traders, it is Sunday, December 15th, and it's time for our weekly video. I've put so much time and effort into all this, I had no idea that it was so easy. I've been watching a couple of my videos to make sure that my messaging is coming through loud and clear. Before I watched them, I saw this ad. Who knows? It could have played before the video that you're watching right now. Buy on blue and sell on red. Wow. That sure simplifies this whole process. I don't know who these idiots are. Do not trust anything that you see leading into my videos. This is really hard work. And I think you know that. If somebody had a secret formula, you'd never know about it because all they would do is run their algorithms and trade the living hell out of it until there was no liquidity left for them to trade that system. That's how it works. So please put the time in, learn this systematic decision-making approach, and you will be much better off for it. You know, I don't advertise. If I did advertise, my ad would go something like this. Come in and sign up to learn my systematic trading approach. This is going to take you 2 years of really hard work and you won't have anything to show for it. And on occasion, if you post a bad trade in the chat room, we'll march you right out on stage with your pants around your ankles. Doesn't that sound exciting? It's going to take a long time. It's a very tough journey. So if you've watched my videos in the past, please give this one a thumbs up. Help me reach as many traders as possible. You know that I start all of them out with a review of my previous pick. That's how you can tell if this approach really works. Then we go through the system and we find a new pick. We repeat that over and over. I've been doing it for 10 years. So there's an audit trail. It's very clean. It's easy for you to go back and check all this stuff, verify it. It's time stamped. It's on YouTube. It's free. This is not some photoshopped P&L. These trades you could have taken advantage of. It's so much better than a P&L. A P&L doesn't tell you why the trade was taken. There's nothing that you can learn from it. These videos are gold. So please go back in the archives, take a look at a nasty point in the market, and go back and watch videos from that specific time period to see if we got it right. That should help you gain the confidence that you need to really learn this system. So let's take a look at last week's pick. This is not going to be a long drawn out video. I don't have a lot to tell you as far as market conditions right now. Tesla was my pick from last week. And this is what the chart looked like. I loved this liftoff on Friday. I loved the D1 chart. We'll take a look at it in just a second. I had mentioned to you in that video last Sunday, I would love to buy a dip on Tesla. It's a pretty choppy stock. I think we're going to get that opportunity. So Monday, the stock gaps up, and I'd set an alert for an HA reversal on a M5 and an M15 basis in that video a week ago. So Monday morning, I get the alert right in here, and I posted in the chat room, hey, HA reversal alert, Tesla. That was a beautiful entry point somewhere around the 384 level. Look at the stock. It closed at 436. Dynamite pick. What did the market do? This is a 1 hour chart of the market, and you can see how the market did hit a peak, and now it started to back off with a lower high double top. Is this something super threatening? Nah, I can't really say that. I do sense that the market is starting to run into some resistance here. It's compressing, okay? Nothing more. This is a compression. The next leg higher could come, or we could get a dip. I don't know which of the two scenarios is going to play out. In my live event on Wednesday, first time, I think all year, I didn't give a pick. I don't have a good feel for where the market is going right now. And so I'm telling all of you to trim your swing trading exposure. We've been bullish to this point. We've made a lot of money to this point. I don't know where the market is going from here. I have to wait for those signs. If the market breaks out to the upside, I'm not going to chase it here. We've got an FOMC statement coming out this week. Everyone's expecting a quarter-point rate cut. Bonds are doing something unusual right now with a dovish Fed that is cutting interest rates. Bond prices should be going up. They're not. Bond prices are going down. What gives? I don't know what gives. I only know that there's a disconnect, and that makes me suspicious. Let's take a look at TLT, US 10-year Treasuries, and you can see that is a very steady decline. Bond prices lower, yields higher. Yields higher, the Fed is cutting interest rates. What the hell is going on here? When you don't know, you tread cautiously. And you can see how TLT is testing this upward sloping trend line. There's a horizontal support level right here. It got smacked down below this 200-day moving average. It doesn't make sense. So keep your trading light. We're going into year end. Much of this year end rally has been fabricated, let's say. What do you mean fabricated? Well, asset managers are not super aggressive, and we know that from the really light volume that we've seen recently. They will buy dips. They will buy that dip. They will buy that dip. They will buy that dip. But what they are not going to do is they are not going to chase that high. They're not going to chase that one. They're not going to chase that one. They're not going to chase that one. And they're not likely to chase this one. They are simply sticking with their positions into year end. They're not making any major decisions. If they get an opportunity to buy a dip, they will. Otherwise, they're not out there gobbling up stocks at an all-time high. So just from an odds standpoint, first and foremost, I view the longer-term market scenario as 50-50. I don't trade 50-50 scenarios. Okay, we're in hand-to-hand combat right now. We can do some day trading. We can look at the intraday price action. I think you're going to see good two-sided price movement on certain days. Monday, not going to be a lot going on. Tuesday, not a lot. Wednesday, not a lot. Everybody's going to be waiting for the FOMC statement. Now, because Friday is triple witching, we can expect one of these days to produce a big move. Okay? Could be Thursday after the FOMC statement. I don't know, but there's going to be position rolling that takes place. So the December futures contracts are going to expire. So traders are going to be rolling from the December expiration to the March expiration. And their positions are a combination of options and futures and stock baskets. And as they do that, they unwind those positions. These are all hedged positions. Oftentimes, if they sense that there's going to be a directional movement, like a trend day in any particular day, if they sense that that momentum is reliable and it's building, then they are going to be inclined to programmatically unwind those positions and to take advantage of that trend and actually goose their returns. So a little bit complicated, but the point of it is that if we get a trend day in here and the trend looks really nice and tight and orderly and there's some decent volume, which you're going to have decent volume because everybody is rolling positions. It's not decent volume because there's any earth-shattering news. It has to do with what's happening with the trading programs, which, let me also make another point. When you're in these lower probability environments, like we've seen over the course of the last 2 weeks or so, where you get these tiny little bodied candles in here and light volume, what does that tell you? Well, it tells you that the institutions aren't involved and that all of the intraday activity is programmatically driven. So you're trading against algorithms, and that makes the price action very unpredictable. What looks fantastic 1 minute can change in an instant. And you're scratching your head going, what happened? Was there some kind of news? Where did that come from? Everything looks so great, and then the rug got pulled out from under us. Well, it's because there isn't any huge size. There's no big motivation right now on the part of asset managers. They want to let this market float higher. They want to mark their portfolios up. That's how they have more assets under management, because the value is greater and their percentage management fees are higher. Okay, so they have disincentive into year end to sell. Now, if we compare that to where I was a year ago, let's zoom in on that. A year ago was right in this area here. And what was I saying a year ago? Buy, buy, buy. Buy, buy, buy. Buy, buy, buy. Buy dips. Any dip is an opportunity to add to your positions. You should be long swing trades. Man, you should be so long swing trades, they're coming out of your ears. Quite a bit different than where I'm at this year. Well, what's changed? What's changed is that the market posts some of its biggest gains after you've had a big pullback. Well, in 2022, we had a bear market. In 2023, we started to show some signs of recovery. Finally, the market was starting to recover from this downtrend. Okay, well, that tells us that asset managers are going to be ready to allocate. They're going to be anxious on any pullback. So August through October, we get this pullback right in here. Not in here as we were pulling back to this 200-day moving average. Please go back and watch my videos from October 31st of 2023. We were already lining up our bullish candidates in here because I knew that once we released, this was going to be a huge rally, okay? We were now going into a trend reversal. And the trend reversal that's 2022, and this is where we started to reverse that downtrend. This had the potential to generate some explosive moves. So this was going to be a great opportunity for us, and we had asset managers in there thick as thieves on that rebound. So when we take a look at that price action, look at the volume. Look at that big volume all in here. And that's when you get this beautiful, nice, tight price action, okay? And that's all because the institutions are in there buying up the market. So we don't have that right now. And the programs, the institutions, many of them that do proprietary trading also execute trades for large asset managers. Citadel, classic example. So they do proprietary trading. They also fill orders for large asset managers. They help them mask that order flow as best they can. Citadel knows what's on the books. They know what these asset managers are trying to do. They can feel all that buying pressure. So are they in there running their buy and sell programs back and forth when they see that type of one-sided demand? Heck no. When all that volume dries up and asset managers are content with what they currently have on, you start getting bigger dips along the way, and the price action starts to get a lot choppier. The volume dries up, and then what happens intraday is you get all this random price movement because there's no long-term money coming to market. This is all programs just testing the bid, testing the ask, testing the bid, testing the ask. They test the bid. Oh, the bid's pretty strong. Okay, so now we're bidding. Now the market's going to go higher. We've sufficiently tested it until they get to a point to where they test the ask. Ooh, ask is pretty stiff. Ooh, they test it again. It's pretty stiff. Okay, it's not going higher. Full reverse, send it lower. And this is all done programmatically. So all that volume is just garbage. So let's take a look at a 5-minute chart and see what sense we can make of it. And so you get price action like this. It's just very choppy. And at the drop of a hat, what looked good the previous day all of a sudden turns to mush. There was no news in here. There was really nothing. It was just a bunch of back and forth. You start getting these long candles. Oh, hey, everything looks great. Wow, this looks like a good move. I could really get behind that. And then whoosh, the bottom drops out. Where did this come from? This was looking pretty damn good in here. Look, we're even in the gap. All right, that's pretty good. Previous day was really nice. Found support at that open, tested it, bounced violently off of it. Looks pretty good to me. And then, nope. That was all just fake. And so now you make a lower high double top, and now you start selling off. This is just back and forth price action. There's no pace to it. Fortunately, we aren't trading the S&P 500. So if we have the right stocks, strong or weak, a lot of this noise is going to be filtered out because we're in a good position. And so you can see that this move that took place Wednesday, Thursday, Friday, Tesla is absolutely oblivious to it. 15-minute chart. So we'll take a look at Wednesday, Thursday, Friday. March, March, March higher versus market selling off. Look at the March higher. See how nice and tight this is? Ooh, that's just awesome. Man, that is the kind of pattern you want. Okay, so we come in Thursday, stock pulls back a little bit, but then it gets right back on track Friday. Look at this garbage Friday. I mean, the market sells off, stock oblivious to that move. That's why we trade relative strength. That's why we use stocks as a surrogate market condition, surrogate market position. We don't want to be subjected to all of this noise. So right now, you've got a market that is really not going anywhere. And if you look at a professional blackjack player or professional poker player, when they don't have the odds in their favor, what do? They trim their bet. They do nothing. They sit on the sidelines and they wait in cash. The guys that are out there constantly betting the same amount of money are never heard from again because they lose all their money. They're gone. They're not smart. They aren't reading the odds. Right now, the odds are low. I feel that the market could make one more really nice big push higher, but I'm not going to trade it. I feel at this level that asset managers are not going to be fueling that move. Everybody's already expecting a rate cut from the Fed. Why the hell are interest rates going up when the Fed is cutting? That also doesn't make sense, and it tells me that perhaps the Fed in this statement is going to be cognizant of that and that they might be saying that, hey, we're not going to be cutting rates anytime soon. Inflation is starting to heat up a little bit. We started to see hourly wages at 0.4% in the last unemployment report. That wasn't particularly good. CPI came in at 0.3%. That's a little hotter than they would like. PPI came in at 0.4%. That's a touch higher than they would like. So maybe this is the last rate hike. I don't know. I don't know what is going to happen from this point. So that's why I didn't give a trade or a pick on Wednesday. I'm trying to send a very clear message to all of you that this is a time to lay low. But I am going to give you a pick because I can't go 2 videos without a pick. So I'm going to find something that's really good. Hopefully it will perform like Tesla, but you should be focusing on day trading. Day trading, day trading, day trading. If we get the dip that I suspect is coming, the depth and duration of that dip is going to tell me how aggressive sellers are. And if they're not super aggressive, then I would be willing to buy that dip, perhaps somewhere around the 50-day moving average. If I see very heavy selling that takes us through these major moving averages, I'm probably going to be day trading from the short side, and I'm very happy either way, trading long or short right now with the market in this tight compression. I don't mind trading either way. I've seen some pretty good shorts recently too. A lot of the basic material stocks, particularly weak. So in any event, if we get a nice deep pullback, let's say down to AV WAPQ or perhaps even lower, then I'm going to know that the selling pressure is relatively heavy and that there is profit taking. And then what I'll be looking for is a meager little wimpy bounce that can't get back to the all-time high. If I see that, then I'm going to know that there's a good chance that the next move is lower and that the 100-day moving average gets challenged, and I will trade accordingly. It's also possible on a light little brief shallow dip that attracts enough short sellers in here and that we're going to see a big boom year-end rally. So that's what I'm watching for. In the course of the next 2 weeks, I know the volume is light. I know asset managers are not going to chase. If I get a brief, tiny little dip, I might buy it for a little move higher into year end. If I see a dip that is more considerable, it's going to be a warning sign to me. It's going to be a red flag. And then I'm not going to be buying very aggressively on that dip. In fact, I'll be watching to see if we make a lower high double top. I hope that's crystal clear to all of you. So this is a juncture where we evaluate. Cash is a position. Cash is flexibility. So the warning has been served. Let's find a stock. I'm going to go right to green royal flush, and I'm going to go right to Marvell. I love this D1 breakout. Why? Well, the stock doesn't make big moves. Compression, 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 little pop. Compression, compression, compression. Oh, there's an earnings release. Boom. This is a nice big move higher for this stock. And you can see that a lot of this gap held. I like to see at least half of the gap hold. So it does. And the stock doesn't make big moves, so it kind of drifts lower. We know that we don't want to chase moves higher after earnings announcements for 5 to 10 days. We need to let the stock settle down because eventually it's going to show us its true colors. If this was all fake, selling pressure is going to fill that gap and the stock will continue to retrace because of profit taking. On the other hand, if we see half of this move preserved, sometimes the whole move is preserved. That's even more bullish because the stock just continues to tick higher. In this case, it pulls back halfway, finds support at EMA 8. Nice. Everything looks good. It's starting to form a little bit of support in here. It's got some decent relative strength. And then look at this candle on Friday. Boom. bullish flag, there's your flagpole, breakout above a VWAP E. So if I look at this, I could structure a bullish put spread. Would I be happy to buy this stock at a VWAP E given the move on Friday? Also a breakout to a new relative high. This stock is going to continue to go higher. I don't know that the market is going to provide much of a tailwind for it to go higher. I hope that it doesn't provide much of a headwind. If the market is just flat, this stock is going to continue to float higher. So I want to take advantage of that. And if I look at the option IVs on this, they're at about 46. So I could sell an out of the money put right in this area here below a VWAP E. Would I like to buy the stock at that level? Sure, I think that's a good point. And that a VWAP E is around $114. If I look at next Friday's option expiration, I think I can get about 60, 70 cents for that. Not being very well rewarded, but if I'm just looking to generate some income, and if I'm looking at time premium decay, whittling away at this stock, yeah, I could certainly do that. You know, it's going to generate a pretty decent return. I mean, it could be somewhere in the neighborhood of 5% in a week. Okay, that's not too shabby. So if you've got the capital to sell a naked put, I would certainly do that. I wouldn't have any problem with that because my expectation is that the market's just going to kind of waffle around the rest of the year. Don't know that there's going to be a big reaction to the Fed. We'll wait and see. The other alternative is to be a little bit more aggressive with a position like this. And we know that when we're buying premium, we want to go out as far in time as we possibly can. So when we have a chance to go past the next earnings announcement, which given that it just announced earnings, we would be going out into March expiration. And we would want to buy an in-the-money call option with a delta of 0.7. So if we look at what call options we might have, and we go into the March expiration, we can see that the 110 calls, there's about $1 between the bid-ask spread. So they're $18.80 bid, let's call it 19 bid, offered at $20. Could you get in for $19.50? Probably. Pete, should I wait for a dip? Yeah, if you can wait for a dip, you should wait for a dip. I don't know that you're going to get a dip given the price action that we've seen and given this breakout. What did that breakout tell us, by the way? We're always trying to evaluate price action because price action tells us how motivated is one side or the other. So you've got nice big gap up. You've got some selling pressure that comes in, but the stock starts to find support here once it's filled in half of that gap. And buyers are getting anxious. So they're looking to enter. All of a sudden, the stock gaps up on Friday. Now the buyers have exhausted the supply of stock and they are getting super aggressive. Our odds of this trade are very high. The odds of this stock moving higher are also very good. So we look at that 5-minute price action on Marvell. You can see stock gaps up and it closes near its high of the day when what? When the market was selling off most of the day. This is strong price action. So yeah, I like Marvell. That's going to be your pick of the day. And I'm sorry, but I haven't made it easier for you. You can't buy on blue and sell on red. But I think that you're going to be able to find a decent entry point on this stock. I cracked myself up. I think you're going to find a good entry point on this stock on Monday. I'd be looking for very light price action Monday, Tuesday, and Wednesday ahead of the Fed. There's not a lot going on. Asset managers aren't doing a whole lot. If you get a really nasty little sell-off in there Monday, Tuesday, or Wednesday, guess what? It's probably program driven because nobody is out there selling stock like there's no tomorrow. So you know that it's kind of a fake little pullback. Look to see if you can buy a dip on the stock. That would be great. Know that you might not have an opportunity to buy a dip. We don't know what the market's going to do. So if you like Marvell, like I do, you can come in and take a very small little position, take a tiny starter position on this, knowing that you might not get the dip that we're looking for. So you come in and maybe you take a small position at say $19.50. You buy one call option. These are out to March, okay? So we are spanning the next earnings announcement. Lots of time for this to work out. The options also have a delta of 0.7, so they are going to move with the underlying stock. What could possibly happen on the upside for Marvell? Does it have plenty of room to run? Well, yeah, heck yeah. It's got a lot of room to run. There's the weekly chart. You can see this stock is absolutely lifting off. Beautiful. So we start scaling into the position. We know it's got plenty of room to run. I mean, if it makes it up to even, let's say it goes $5 higher. Let's say that it, at $5 higher, you're going to make $3.50 on those options that cost about $20. So now you're looking at a return somewhere in the 15% range over the course of a few weeks. That's a nice return, okay? And you're able to add to the position. If it continues to move higher and the market looks good, you can continue to add a little bit at a time, knowing that this is a longer term position. But again, I don't have the confidence in the market to take a lot of longer term swing positions right now. I'm kind of looking at in and out. I like day trading underlying stock. I would have no problem day trading Marvell. And then just seeing and waiting for this dip. I mean, that really is what I want to do now. I want to be in cash as much as possible. I would like to see a dip somewhere above the 50-day moving average, brief and shallow. And that would tell me that maybe we're going to get some impetus into triple witching and that those programs can actually fuel a breakout to the upside. I think that's very possible. Most of the triple witching sessions that we've seen, the week into triple witching, have been fairly bullish. They've had a bullish bias to them. So that's kind of what I would be watching for. Obviously, anything deep and nasty between now and January, I start to really watch with raised brow. That's a warning sign. That's how I'm positioning myself. So Marvell's your pick. Be prudent with it. Reduce your risk into year end. We need that dip. That's going to tell us how aggressive sellers are. If they're not that aggressive, then we'll have another opportunity, and perhaps the market will have one really nice leg higher. 620 should be a resistance level. So that's where I start getting very, very cautious. And if you take an upward sloping trend line that goes through that point, comes right about in there around that 620 level. So that is a high plus trend line that could be a target that we see into year end. Thanks so much for watching, everyone. If you like the content, please give it a thumbs up. If you have any questions on stocks that you're looking at, please post those in the comments and I will try to reply to those as well. We do have a Wednesday live event coming up, and a week from today, I'm going to give you my forecast for Q1 of 2025. So watch for that as well. Trade well. We'll see you then.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.